Hey there, welcome to the channel. So Jpow says, screw you, market. All right, so we have been having, so we'll just kind of start from the beginning with the SPY here. We've had a decent rally here, okay? And so what's gone on is that you can see that I believe we're kind of in a bear market, right? But we've had this kind of near term, really for over a month, we've had this uprising in the market, and it's come up to this key point here, like the SPY has come up to the 200-day moving average. So, remembering bear markets, the way it works is generally the trend is down and they will find resistance at moving averages. Whereas in a bull market, you'll find support at moving averages. So you can see that this is just a classic kind of, hitting the wall at the 200-day moving average as far as like the spiders are concerned. Now, today we got a big old negative bar on an increase in volume. And what was this all about? Well, Jpow was making some statements at his basically they have their Jackson Hole blah 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 speech. So he made some statements. So let's see what this dude is saying. So Powell warns of some pain ahead as the Fed fights to bring down inflation. Now, a couple of interesting things that he's talking about here that are kind of interesting. Fed Chairman Powell on Friday pledged that the central bank will use our tools forcefully to attack inflation that is still running near highest level in more than 40 years. Interesting. In his annual Jackson Hole speech, Powell added that higher interest rates likely will persist for some time. The historical record cautions strongly against premature loosening policy. The remarks come amid signs that inflation may have peaked, but is not showing any market signs of decline. So let's see. So this is reported by CNBC. Powell said that the Fed will not be swayed by a month or two of data. Oh, that's a bummer right there for the market. See, because when you look at the inflation data, the CPI data that we got for the last month, it looked like it had actually kind of inflected. We had a month over month that, they do the year over year, month over month was zero. Year over year had inflected down a little bit. So it looked like, hey, maybe the inflation is peaking and everything's good. And then the Fed's going to pivot. They're going to cut back on their rising interest rates. Well, Powell just said, "Screw you guys." He's like, "Screw you guys." No, I'm gonna keep cranking up interest rates right now, and when a person at the Fed, a chairman of the Fed, tells you that there might be some pain and we're going to act forcefully, yeah, that's pretty damning. So the response in the market was pretty huge. We had a big sell-off today on S&P, 3.3% down. But here's the key. The key is now we go back to the big picture. We've got the weekly chart. We've got 2.5 years of data up here. And if we're looking at this data here, what we are seeing is we're seeing that this downtrend here. And what's interesting is you see how we came right up to this red line here, which is the 50-week, which is equivalent-ish to the 200-day moving average. And you see what happened is that it failed to get above it on the S&P 500. So this is like a hard fail. And see, the thing is, you can kind of come up into there and maybe you come back and pull off a little bit and you kind of set up to push back over it. But this was like now a hard sell off that. And so what really happened today is actually very significant because it's really kind of, delineating that, well, if you thought that we were maybe coming out and we were putting a low in and we were basically building a base or starting to reverse to come out of the bear market, today really shot that. It shot it for the week because now you're sitting there, look at that. You have a nice downtrend line in place. You failed at the 50-week/200-day moving average. You have sort of a consistent situation across all the indices. If we look at our Qs here, see, look at the Q. In a way, the Qs are even weak because look at all that daylight. Look at all that daylight between the 50-week and where it came up to. So it definitely was really a significant day for the market in that regard. So what we see is, as far as I can tell, This is how the bear markets run, right? They fail at the important moving averages. That's what happens. So if we try to go back in time, I think what we can do is look at some other SPY sell-offs. Okay, so if we look here, you can see that this current sell-off, as far as the SPY, which is the spiders S&P 500, they track pretty well. It's not a big deal. We're off 23%, but we've made a decent rally. We've gained back half of that, so you had a decent little rally there. But one of the things you want to do is, like, I want to really look at '08, and I want to really look at 2000 here. Now, 2000 SPY was not in the center of it, and it was not in the center of it really back in 2008 either. But in both those cases, the full nature of the decline was 46% and 54%. So, the fact that we went down 23% doesn't necessarily in and of itself mean that we are done. So let's kind of look at these periods of times. Let's see if we can zoom in there. So this chart's a little busy, but when you're looking at what happened in 2000 with the SPY, you can see a similar, kind of thing here. You see how, so the red is the 50 week, which is the 200. So you see that it's rotated, and that's what we see now currently. The 200 day is now pointing down. You see that we have these rallies, like over here, it rallied up, almost got to it and failed and made a new low, right? You had a low, rally to it, a new low. And then you come up and you even break above it a little bit here. Here we had a nice trying to base up there, but then it just failed and continued to go down until you put in your final base. Okay. So there's a couple of things that we could look at in 2000 to see when you're in the bear market. The main deal is, look, you come up into the 200-day, 50-week moving average, you're going to fail. That's just how it works here and here. And then it really takes a struggle to put in a base. But the other thing to note, the black line is the Fed funds rate. So even though the market was selling off, the Fed was coming in here. Look at, they were up here at 6.4%, believe it or not. And they were starting to bring it down. And they didn't really get this market to turn around until they finally brought it all the way down here to about 1%. So there's a couple of things to keep in mind. Currently, the Fed is talking about still increasing rates. And this whole time that this market sell-off was going on here, the Fed was lowering rates. So that can only be, it's a little bit different situation, and it can only be actually more negative. Right. The Fed is actually still applying the pressure. Now, the difference here is you had rates were more normalized before this for a period of time. However, as soon as the market really started breaking down, they were trying to fix it by lowering rates, and they're not doing that right now. And the indication from the Fed is that he isn't planning on doing that. And what he's really telling you, hey, screw off. I don't care about your stock market and your carried interest. So now here, let's look at what happened in '08. Once again, a very similar situation. You had the 50 rolling over, the 50-week 200, you rallied up into it, and then you fail. And you kind of like find these areas to sort of hold support for a little while, then rallied, really weak rally, and then just totally broke apart. And then you still had many months of just time churning it out until you put this like really hammer low in here, and then you finally start coming out. And then once again, all that time, the Fed is over here lowering rates. They started lowering rates back here with this yellow line, as you see the black line. So they're already lowering rates. So where are we now? What's going on right now? Well, if we go to our current situation, the Fed is still cranking rates. So you've had this pull off of 23%. And once again, we're looking at the same thing. The red line here is the 50 week. And you see that, and I'm going to zoom in. You can see right here what just happened. The Fed is still cranking rates, and they're behind the curve. But the thing is, we just had this rally into the 50 week, and it failed. And they're still raising rates. So what does this mean? So in the last two that I showed you, the last two market crashes are really big corrections. They're not short corrections, they're big corrections. What was going on at that time? What was going on is the Fed responded to something going on, whether it was the market selling off, or something else going on, whatever they were lowering rates. Here they're raising rates into the market that's already declined by up to 23%. So I think it's really important to keep that in mind, that this situation is somewhat different than the last two market crashes that we had. In addition, it's very different to this one here, which is what I would call the cerveza sickness, aka George Gammon. What happened here is they just printed money so fast. I mean, they come out, oh, cerveza, they're at 1.5%. They basically overnight they drop it to zero. They drop it so quick, and at the same time all the government stimulus checks, all that stuff went out. Just crazy, right? Crazy money being pumped into everything. It always ends up going into the market. So that's where we stand at this point. So in conclusion, what's really going on is today was very significant, because what the Fed told you is they said that, well, they're not done yet. They're not buying it. They're not sold that the inflation that we saw, the last inflation numbers, were actually enough for them to be encouraged to start holding off on their rate increases. So it sounds, based on what the Fed is saying, that they're going to keep increasing rates. They're going to keep going. So not only, another 75, maybe another 75 and another 50 after that. They're going to keep going until they really squash this inflation. And you can really see that because when you look, and we have these Fed news conferences now, which are newer, right? That wasn't, I'm not sure, but that was a relatively new thing. I think 10 years ago they didn't have that. And but when he comes out and his opening statements spend half the time talking about how inflation is hurting the average American, you can understand that that's where his focus is. So he doesn't care about this. 23%, like Jerome, don't give a crap. He could care less about that. It's only if it leads to something else. So if you look at it, is the economy strong? Well, there's all kinds of problems in it, but by the measures that they continue to use, we still have really good employment. We still have, good consumer spending, even though it's not really adjusted for inflation. Things are still going along. I mean, there are lots of problems. We see this with the cars, the repos, all this stuff, and a lot of other channels kind of point out these issues. We have the high oil price, we have the natural gas issues. We apparently have more turbines, et cetera. And, Europe is going to be a big issue come this winter. They're apparently going to shut down the pipeline again, and they're talking about getting it back up to 20% instead of 40%. They're really squeezing. They're really squeezing Europe. And all these things are going to come and play out. But for right now, it seems like the Fed has just told you. I mean, they're doing what they told you they're going to do, and they care about inflation. They do not care about the stock market. So I think that's why it sold off. All right, that's it for this one. Talk to you later. Bye.